Hello, this is Chuck Carnevale. I'm the Chuck in the Markets Up Chuck, and today's blog was titled "Google Growing and Growing," and I wanted to basically, kind of in light of the concept of investor education this week, I want to talk about growth stocks, and Google, of course, is probably the classic quintessential example of a growth stock today. But I want to talk about how the relationships between growth and shareholder returns and earnings and valuation all come into play over investing. So first of all, let's look at Google from a standpoint of how long it's been in business. If Google went public on August 31st, 2004, and since that time, obviously their earnings growth has been extraordinary. But one thing that I want to make sure you understand when you're looking at charts like this, the rate of change of earnings growth since 2004 has been over 74%. But you have to understand that Google had a 400% increase in earnings the first year, then 105%, then 80, then 30, then 11, then 50, then 15. So clearly, the 74% growth is a little misleading and is driven primarily by the 400% growth in the first year. But having said that, if you look at Google, and by the way, the company has no debt. Another point I'd like to make before I go much farther, the quality of earnings that Google generates, in my opinion, are very strong. They actually throw off more cash flow or higher cash flow than they do earnings per share, which I think is a great attribute of a company. But if I look at Google, from a shorter time frame, if I cut that first year off and draw this chart 1 year shorter than the 7 years and look at it just from the perspective of earnings, then the rate of change of earnings growth drops down to 45.9%. Now, I want to interject the concept of valuation. I want you to notice that Google was tracking what I would consider to be the more realistic or actual earnings that they achieved during this period, again, throwing off that extremely high year, but we still have some bias of some, a couple of high years here followed by some lower years with a pretty strong year mixed into the middle. But when you look at all this, the point I want to make is this. It was based on this definition, somewhat, maybe in value to overvalued or slightly overvalued, and it's kind of ending this period slightly undervalued based on, this growth rate. This company normally has traded at a very high price earnings ratio, but it currently only trades at around 25 times earnings. The company has no debt on the balance sheet and generates strong cash flows, but look at the track record the shareholders have returned during this period of time. $100,000 investment on 12/31/04 or held through October 29th, 2009 would have grown to $285,000. That's a 24% rate of return, even though Google's undervalued, and that's during a time when the stock market lost, a compounded 2.5%. So, valuation is obviously an important factor, and so is growth rate. Now, let's throw off another year here. Let's throw off the 100% year here and bring this down now to a 5-year chart and kind of get a picture of what's happening. Now we run into a little different story. The growth rate now drops down to 36%, and now we have a period where it's overvalued based on what the growth has been for the last 3 years and ending undervalued. So now the track record has dropped to 6.7%, but this was during a very bad time in the market where the market was losing almost 5% compounded, turning 100,000 into 80. A shareholder in Google still would have seen a modest return based on the fact that we had tremendous earnings power in this company. And then if I drop that down to even one more year, just to bring this to look at more currently. And remember, when I'm drawing these charts, this says a 4-year chart, but I'm really only looking at 3 years here because I always have 1 year of forecast. So really for the last 2 years and 10 months, almost 11 months now, Google's averaged about 26.6%. What's interesting about this is that this actually reflects the current forecast growth rate for Google right now. So the consensus of the leading analysts following the company believe that Google is going to grow in the future at around a 26.5%, or this is now, you might say, is getting closer to a more normalized growth rate for the company. So on that basis, Google would be in value today and be very fairly priced relative to this enormous growth the company has. But I guess the real message here was that, you got to make sure you're looking at the math and looking at the numbers and analyzing the numbers. A couple of really big years in the beginning, when you look at Google's, total chart throughout the entire history of the company here, a couple of numbers really distort the growth rate. 74% was the average, but it was because of a 400% and 100% growth years. But, more realistically now we're starting to see numbers that are making more sense. Google's exceeded analyst estimates more recently. This company still, in my opinion, does have a lot of growth, but I would encourage you to do your homework and come up with your own thesis for growth, because ultimately it's the rate of change of earnings growth that's going to determine returns. This is Chuck Harmel saying thanks for listening. As usual, it's Friday. I'll be taking the weekend off. I appreciate your tuning in this week, and look forward to talking to you again next week. Y'all have a great weekend and a happy Halloween. Thanks.